Hello investors and future investors, welcome to the channel. In today's video, we will be discussing option Greeks and how they help make you a better options trader. If you're trading options and do not know or understand the Greeks, then you're just gambling with options. But no worries, we will help change that today. If you're new to the channel, thanks for stopping by. On this channel, we help you with option strategies that can give you consistent revenue and everything related to finance and investments. Welcome to Investment Gains. Let's jump right into it. Option Greeks is not a very spicy topic, but it is of extreme importance to traders. The Greeks help us determine our strike prices, strike dates, and option premiums, and how they all correlate. So, to start off this video, please allow me to introduce the Greeks. Coming in at number 1, we have my main man, Delta, and he is responsible for price movements. In a close second, we have Gamma, and he is also responsible for price movements. Third place goes to none other than, drumroll please, Theta. And as you may tell from my excitement, this is my favorite Greek. In fourth place, we have Vega, and although he may be in fourth place, he is not to be underestimated and has been solely responsible for blowing up traders' accounts. Lastly, we have Rho. Now this Greek only deserves an honorable mention because not much attention goes his way because he has a lot to do with interest rates, which lots of traders don't focus on when trading options. I mean, have you ever heard a trader say, hold up, before I buy this option, let me check the Rho? Nah, that hardly ever happens. The Greeks work hand in hand to determine an option's value, and it's a bit difficult to talk about one without mentioning another, but I'll give it my best. So, we shall start off with Delta. I consider Delta to be the main guy because he has the biggest impact on an option's value and is responsible for price movements. Delta identifies how the option premium may change if the underlying price changes by $1. So, an option with a delta of 0.5 will be expected to increase by $1.50 if the stock price goes up by $1. Delta also helps with identifying the option probability of expiring in the money. So, an option with a delta of 0.5 gives you a 50% chance of the option expiring in the money. So the lower the delta, the lower your odds are of the options expiring in the money. Delta moves in two directions. It grows as the option moves further in the money, and it goes down when the option moves out of the money. Let's move on to Gamma. Now, I did say that Gamma came in at a close second, and the reason for that is because Gamma 2 is responsible for price movement and helps to determine the delta. So Delta and Gamma are pretty much homies. So, what does Gamma actually do? Well, I'm glad you asked. Gamma measures Delta's expected rate of change. So, if an option has a delta of 0.5 and a Gamma of 0.1, then when the option goes up by $1, then the option price will increase by delta plus Gamma, or $1 plus 50 cents plus 0.1 equals $1.60. Hopefully you understand that, and if not, then I suggest you replay this part of the video. Now, let's get into my favorite Greek, Theta. And I'll tell you in a bit why this is my favorite Greek. Theta measures how much the value option loses every day. An option with a theta of 0.05 will lose $5 every day until expiration. So, a $20 option will decrease by $5 every day, making it worthless after only 4 days. So the reason why Theta is my favorite Greek is because Theta works for option sellers, but works against option buyers. And if you're not new to the channel, you know that I'm predominantly an option seller. Our fourth place Greek is Vega. And although Vega is fourth place, is a boss in his own right and should never, ever be underestimated. Vega gives an estimate of how much the premium may change with each percentage change in implied volatility, or IV. So, if a $2 option has a Vega of 0.05, then that option's contract will be reduced by the IV of 0.05 and will now be worth $1.95. Just so you know, IV is not to be trusted, and he can be influenced by many outside factors including rumors, news, or even earnings reports. And any one of these factors can change your Vega which will make your IV go up or down drastically. And this is why you hear so many horror stories on Wall Street Bets or Reddit. Or perhaps you heard the reverse stories of rags to riches. Vega can help or hurt you, and it all depends on outside factors. Here's a tip for you. The further out your strike date is, then the higher your Vega will be, because the option has a lot of time attached to it, and it can be easily influenced by these outside factors. And that's why, as an option seller, I stick to shorter dated options. Lastly, we have Ro. Now, like I said in the beginning, Ro deserves an honorable mention because he does show up on the options chain, and I do have to show him some respect. In other words, Ro is like the kid on the block that no one talks to. I won't get into Ro because I do understand how this Greek works, but not enough to explain it. Let's jump into actual option Greeks so I can run you through a snapshot as a visual representation. So here we are on the SPY ETF. For this example, we're going to be using the $412 strike price with a share price of 417.33, and the cost of this option is going to be $5.39. Our delta here is 0.94, our gamma is 0.03, our theta is negative 0.09, and our vega 0.03. Okay, so let's start with delta. We're going to make our way down the line to the other three. So let's say the share price moves up by $1 from 417 to 118, then the cost of this contract is going to go up by delta, or 0.94. That's delta, pretty simple. So let's tackle gamma. So once again, if the share price goes up by $1 to 418, then the cost of this contract is going to go up now by delta plus gamma, or a total of 0.97. Excellent. Hopefully you're still with me so far. Good. So let's tackle theta. Now theta, like I said, has to do with time decay. So every day that goes by, this contract is going to be losing $9 every day, just sitting there doing nothing. That's pretty much how time decay works on an options contract. So Vega, like I said before, Vega has a lot to do with implied volatility. So let's say, as an example, if SPY decides to increase their dividends by 10%, what's going to happen is that the Vega is going to go up. Alternatively, the implied volatility, or IV, is going to go up as well. And the overall impact is going to be the cost of this contract is going to increase as well. There is quite a bit of simplicity in what I've just explained, and that's because I wanted to make this video so that even a beginner investor can understand the concepts of the Greeks. I did mention some concepts that you may not be familiar with, like in the money, out of the money, and implied volatility. I'll try to make a separate video to explain these concepts so they won't be so foreign to you. The more you buy and sell options, the more you will grow your knowledge of the Greeks. Leave me a comment below and let me know if this video was very helpful. Now, we have lots of option strategies on this channel, so if you want to support the channel, like and subscribe and hit the notification bell to get an alert whenever I post a video. And also, share this video with someone you think that it may benefit. Thanks for watching, and remember, you never lose when taking your investment gains.